Tonight, we are going to travel through one of the longest and most remarkable stories in human history. It is a story that begins before coins, before banks, before paper notes, and even before written language. It begins in small communities where people shared food, exchanged favors, remembered promises, and slowly developed systems for measuring what was owed. From there, our journey will carry us through the temples of ancient Mesopotamia, the markets of Egypt, the first mints of Lydia, the trading roads of Persia, India, China, Greece, and Rome, the great commercial cities of the Islamic world, the counting houses of medieval Europe, the voyages across the Atlantic, the rise of banks and central banks, the creation of paper money, the gold standard, the age of credit cards, and finally into the invisible digital money that moves around the world today. So settle into a comfortable position. Let your breathing become slow and easy. There is nowhere else you need to be. For the next little while, we will follow the quiet trail of money through thousands of years of civilization. And our story begins long before anyone had ever imagined a coin. In the earliest human communities, money did not exist as a separate object. There were no prices written on signs. There were no wages deposited into accounts. There were no wallets, coins, banks, or written contracts. People lived in relatively small groups, often surrounded by relatives and familiar faces. They hunted, gathered plants, prepared food, made tools, cared for children, and protected one another. In such a community, exchange did not always happen as an immediate trade. A skilled hunter might return with more meat than one family could consume. The meat could be shared throughout the group. On another day, when that hunter was injured or unsuccessful, other people might provide food in return. No one necessarily stopped to calculate the exact value of each piece of meat. Instead, obligations were remembered. People knew who was generous, who helped during difficult seasons, who could be trusted, and who repeatedly accepted help without returning it. This was not money in the modern sense, but it was part of the foundation from which money would eventually grow. It was a system based on memory, relationships, reputation, obligation, and trust. For many years, textbooks described a simpler story. According to that story, early humans relied mainly on barter. One person had fish but wanted grain. Another person had grain but wanted a clay pot. Because each person had to find someone who possessed exactly what they needed and desired exactly what they offered, barter was inconvenient. Money, according to this explanation, appeared as a solution. Although direct barter certainly existed, historians and anthropologists have found that the reality was usually more complicated. Within close communities, people often relied on sharing, informal credit, gifts, and long-term obligations, rather than strict exchanges. Direct barter was more common between strangers, rival groups, or communities whose members did not expect to maintain close relationships. The difference is important. Money did not simply replace endless rows of people trying to exchange chickens for shoes. It emerged gradually from systems of accounting, debt, taxation, trade, and political authority. Before money became an object, it was often an idea. It was a way of measuring value. Imagine a farming village many thousands of years ago. One family might borrow seeds after a poor harvest. Another might promise several baskets of grain in exchange for help repairing a roof. A craftsperson might provide a stone blade today and receive food after the next harvest. As communities became larger, remembering all these obligations became more difficult. The invention of agriculture, beginning in several regions of the world thousands of years ago, transformed human economic life. Farming allowed people to remain in permanent settlements. Grain could be grown in large quantities and stored. Herds of animals could be raised. Populations increased. Villages became towns, and some towns eventually became cities. Agriculture also produced surpluses. A surplus is more than a family immediately needs. That extra grain, oil, wool, livestock, or other material can be stored, redistributed, exchanged, taxed, or used to support people who are not directly involved in farming. Craftspeople, soldiers, priests, administrators, builders, and rulers could all be sustained by agricultural surplus. But surplus required organization. Someone had to measure what entered the storehouse. Someone had to record what was distributed. Someone had to calculate taxes, debts, wages, and offerings. And so the history of money became closely connected with the history of writing. In ancient Mesopotamia, in the lands between the Tigris and Euphrates rivers, people developed increasingly sophisticated methods of record keeping. Long before full writing appeared, small clay tokens were used to represent goods. One shape might represent a measure of grain. Another might represent an animal. These tokens could be placed inside hollow clay containers. Marks were sometimes impressed on the outside to indicate what was sealed within. Over time, it became easier to press symbols directly onto clay tablets. By around the late 4th millennium BCE, these accounting systems contributed to the development of cuneiform writing. Some of humanity's earliest written documents were not poems or royal biographies. They were records. They counted grain, animals, labor, land, beer, cloth, and other goods. The first accountants appeared near the beginning of recorded history. In the great temple and palace economies of Mesopotamia, barley and silver became important units of value. Barley was useful because it was essential, measurable, divisible, and widely understood. Workers could receive rations in grain. Debts could be calculated in measures of barley. Taxes and rents could be paid from the harvest. Silver was also used as a standard of value, although it was not yet commonly shaped into coins. Pieces of silver could be weighed. Their value depended not on an official picture stamped onto the metal, but on weight and purity. A merchant might carry silver in irregular pieces, rings, bars, or scraps. When payment was made, the silver could be placed on a balance scale and compared with standard weights. This is one reason the language of money is filled with words connected to weight. The ancient shekel, for example, began as a unit of weight. It could describe a certain quantity of silver, barley, or another commodity. A mina contained a larger number of shekels, and a talent represented an even greater weight. These units varied between regions and historical periods, but they allowed people to express value in a shared language. A field might be valued in silver, even if no silver changed hands. A debt might be calculated in silver, but repaid with grain, livestock, labor, or another acceptable good. This distinction is essential. Money can serve several different functions. It can be a medium of exchange, something people directly use to buy and sell. It can be a unit of account, a common language for describing prices and debts. It can be a store of value, something that preserves purchasing power for the future. And it can be a standard of deferred payment, allowing obligations to be measured across time. One object does not always perform all these functions equally well. Grain was useful and necessary, but it could rot, attract pests, and become expensive to transport. Livestock could reproduce and provide milk, meat, hides, and labor, but animals were difficult to divide without destroying their usefulness. Metal lasted longer and was easier to transport, but its purity had to be tested and its weight carefully measured. The development of money was therefore a long search for reliable ways to store, measure, and transfer value. Debt became central to this search. Ancient Mesopotamian tablets record loans, interest, rental agreements, business partnerships, wages, and disputes. A farmer might borrow grain before planting season and promise to repay more after harvest. A merchant might borrow silver to finance a trading expedition. A family might pledge land, labor, or future crops as security. Interest was not a modern invention. It existed in ancient societies because lending involved time, risk, and opportunity. But debt could also become dangerous. A failed harvest, flood, war, illness, or sudden loss could make repayment impossible. Debtors might lose land, fall into dependency, or even pledge themselves or family members into debt servitude. To prevent society from collapsing under unpayable obligations, some ancient rulers announced debt cancellations. These decrees could release people from certain debts, restore land, and free debt servants. They were not acts of pure generosity. They were also practical measures. If too many farmers lost their land or freedom, the kingdom could lose taxpayers, soldiers, and food producers. The stability of money and debt was already tied to the stability of government. In ancient Egypt, the economy also depended heavily on accounting, grain, labor, and centralized storage. The Nile's annual flooding renewed agricultural land, allowing large harvests to support temples, royal projects, officials, craftspeople, and soldiers. Workers could be paid in rations of grain, beer, oil, cloth, or other supplies. Records were kept on papyrus, pottery fragments, wooden tablets, and stone. Grain stored in state or temple granaries could function like a form of wealth. The ability to collect, store, and redistribute essential goods gave rulers enormous power. Taxes were often collected in kind rather than in coins. A farmer might owe part of the harvest. A village might be required to supply labor. Craftspeople might deliver manufactured goods. Money in these societies was not always something carried in a purse. It was often a network of measured obligations connecting households, temples, administrators, and rulers. In many regions of the ancient world, people also used commodity money. Commodity money is valuable not only because society accepts it as money, but because the material itself has practical or cultural value. Cattle, grain, salt, tea, cloth, shells, beads, metal tools, and many other objects have served as money. Cattle were especially important in pastoral societies. They represented food, mobility, status, fertility, and productive power. A large herd was a visible form of wealth, but cattle were not convenient for small purchases. A person could not easily divide one cow into dozens of payments while keeping it alive. Smaller and more portable commodities were better suited to everyday exchange. Salt became a form of money in some places because it was essential for preserving food and maintaining health. Blocks or measures of salt could be traded across long distances. Tea bricks were used as money in parts of Asia. Cloth served as a standard of value in many societies because it required labor to produce and was consistently useful. Iron bars, copper rods, knives, hoes, and other tools sometimes circulated as both useful objects and measures of wealth. Cowrie shells became one of the most widespread forms of money in history. Cowries are small, smooth shells, often pale and glossy, with a narrow opening underneath. They were attractive, durable, portable, difficult to counterfeit in regions far from their natural source, and easy to count. Cowries were used across parts of Africa, Asia, Oceania, and elsewhere. They could be strung together in groups, making large quantities easier to transport and count. Because shells were abundant in some coastal regions but rare inland, trade networks carried them across vast distances. Their value depended on location and supply. When merchants later imported enormous quantities of cowries into certain markets, their purchasing power could decline. Even shell money could experience something resembling inflation. Different forms of money developed independently in different parts of the world. There was no single moment when all humanity decided to invent money. Instead, communities repeatedly faced similar problems. How could value be measured? How could debt be recorded? How could taxes be collected? How could strangers trade? How could wealth be stored? And how could rulers pay soldiers and workers? One of the most influential solutions was coinage. The earliest widely recognized coins appeared in western Anatolia, in the kingdom of Lydia, around the 7th century BCE. These early coins were made from electrum, a naturally occurring mixture of gold and silver. A piece of electrum could be weighed like earlier metal money. But now, an authority stamped a design onto it. The stamp served as a guarantee, or at least a claim, that the piece had a recognized weight and quality. This reduced the need to weigh and test every piece of metal during each transaction. Early Lydian coins often carried simple symbols, including the image of a lion. Over time, coins became more standardized. Lydian rulers, including the famous King Croesus, issued separate gold and silver coins with carefully controlled weights. Croesus became so strongly associated with wealth that his name survived in expressions about being extraordinarily rich. Coinage was not simply a private commercial invention. It was closely connected with states, armies, taxation, and political authority. A ruler could mint coins to pay soldiers, officials, builders, and suppliers. The ruler could then require taxes to be paid in those same coins. This created demand for the currency. People needed coins because the government demanded them. The stamp on a coin also carried a message. It displayed the ruler's face, the city's symbol, a god, an animal, a monument, or a military victory. Coins traveled farther than royal proclamations. Each one was a small piece of political communication. The ancient Greek world adopted and expanded coinage rapidly. Greek city-states issued their own currencies, often decorated with symbols of local identity. Athens became famous for silver coins showing the goddess Athena on one side and an owl on the other. The owl was associated with Athena and with wisdom. These Athenian coins became widely trusted because of their consistent silver content and the commercial influence of Athens. They circulated far beyond the city itself. Other Greek communities issued coins featuring turtles, horses, dolphins, plants, mythical creatures, and gods. The designs made coins recognizable even to people who could not read. Coins supported the growth of markets, paid soldiers and sailors, funded public construction, and facilitated long-distance trade. But the coin economy did not eliminate older forms of payment. Grain, livestock, land, labor, and credit remained important. Ancient economies were mixed systems. Coins existed alongside informal debts, temple accounts, household production, and payments in kind. As coinage spread eastward, it encountered other monetary traditions. The Persian Empire issued gold darics and silver sigloi. These coins helped support an enormous imperial system stretching across many peoples and languages. Persian roads, taxation systems, and administrative networks allowed resources to move across great distances. In India, early punch-marked coins appeared, often made from silver. Rather than carrying one unified design, they could bear several symbols punched into the metal. Indian trade networks connected inland cities, coastal ports, Central Asia, Southeast Asia, and the Mediterranean world. Money circulated alongside spices, textiles, precious stones, metals, and ideas. In China, the development of money followed distinctive paths. Early Chinese societies used cowrie shells and objects shaped in imitation of cowries. Later, metal forms resembling tools appeared, including spade money and knife money. These were not necessarily full-sized working tools. Many were standardized objects representing tool-like forms. Different states issued different shapes and inscriptions. Eventually, round coins with central holes became dominant. The hole made it possible to thread many coins onto a cord. Because individual copper coins had relatively low value, they were often carried in strings. The familiar round coin with a square hole later became one of the longest-lasting coin designs in history. The round outer shape and square center were sometimes interpreted through ideas about heaven and earth, although the hole also had practical value in manufacturing and transport. When China was unified under the Qin dynasty in the 3rd century BCE, monetary standardization supported political unification. Weights, measures, writing systems, and currency were brought under stronger central control. Standard money made taxation, administration, and trade easier across the empire. Yet the value of coins depended on more than shape. The amount of metal mattered. Government enforcement mattered. Public trust mattered. If rulers reduced the metal content while insisting that the coin retain the same official value, they could create more coins from the same amount of metal. This practice is known as debasement. Debasement could help governments meet urgent expenses, especially during war. But repeated debasement could weaken confidence and contribute to rising prices. The tension between the face value of money and the material value inside it would continue for centuries. The Roman world offers one of the clearest examples. Early Roman money included weighed bronze. The Latin word pecunia, meaning money, was related to pecus, meaning cattle, reflecting an older association between wealth and livestock. Roman coinage developed as the Republic expanded. Silver denarii became especially important. The denarius was used to pay soldiers, merchants, laborers, and officials. Roman coins circulated throughout the Mediterranean and across distant trade routes. They carried images of gods, symbolic figures, political leaders, buildings, and military victories. During the Republic, placing the image of a living individual on a coin was politically sensitive. Julius Caesar's appearance on Roman coins signaled a profound shift in power. Under the emperors, imperial portraits became normal. A person in Britain, Egypt, Spain, or Syria might rarely see the emperor in person, but the emperor's face passed through their hands. Rome's monetary system connected military expansion with taxation. Armies conquered territory. Conquered regions paid taxes. Taxes supported further military activity. Mines supplied gold, silver, copper, lead, and other metals. Enslaved laborers often worked in brutal conditions to extract the raw materials that supported imperial finance. Money cannot be separated from power. Behind the polished surface of ancient coins were mines, armies, laws, taxes, forced labor, trade routes, and systems of conquest. As the Roman Empire faced political instability and military pressure, its currency changed. The silver content of important coins declined. New coins were introduced, prices rose, taxes became more burdensome, and people sometimes preferred payment in goods rather than unreliable currency. The decline of Roman monetary stability was not caused by one factor alone. War, political fragmentation, disease, disruptions in trade, falling production, changing tax systems, and repeated debasement all interacted. The Roman experience became a lasting example of how currency reflects the condition of the institutions behind it. Meanwhile, across Asia, great trade routes connected empires. The network later called the Silk Road was not one single road. It was a shifting web of land and sea routes connecting China, Central Asia, India, Persia, the Middle East, East Africa, and the Mediterranean. Merchants carried silk, horses, spices, glass, metals, paper, gems, textiles, religious ideas, technologies, and diseases. No universal currency governed the entire network. Merchants encountered many coins, weights, measures, languages, and legal systems. Some currencies gained acceptance far beyond their places of origin because traders trusted their metal content. Silver became especially important in long-distance exchange. Gold was valuable and portable, but often too scarce for ordinary transactions. Copper and bronze served local markets. Credit and partnership agreements allowed merchants to conduct business without physically transporting all their wealth. Transporting precious metal was dangerous. Caravans could be robbed, ships could sink, political borders could close. The history of money therefore became a history of finding ways to transfer value without carrying the value itself. This idea would eventually lead to bills of exchange, bank deposits, paper money, electronic transfers, and digital currencies. But first, we return to China, where paper money emerged earlier than anywhere else on a large scale. China developed paper itself centuries before Europe. As trade expanded during the Tang Dynasty, merchants sometimes found it inconvenient to carry enormous strings of heavy copper coins. In some regions, they deposited coins with trusted agents and received paper receipts. These receipts could be used to reclaim the deposited money. Over time, some receipts began circulating as payment. People accepted the paper not because the material itself was valuable, but because it represented a claim. During the Song Dynasty, governments became increasingly involved in issuing paper currency. One early form was known as jiaozi. At first, merchant groups issued notes. Later, the state established greater control. Paper money offered clear advantages. It was lighter than metal, easier to transport in large amounts, and less dependent on immediate supplies of copper. But paper money required confidence. A piece of paper was useful only if people believed it could be exchanged, accepted for taxes, or passed to someone else. Governments had to limit issuance, prevent counterfeiting, and maintain credibility. When too much paper money was printed without sufficient support, its value declined. Inflation followed. Later, Chinese dynasties experienced both the promise and the danger of paper currency. Under Mongol rule, paper money was issued across a vast territory. The traveler Marco Polo described his amazement at a system in which paper, backed by imperial authority, functioned as money. To people accustomed to gold and silver coins, it seemed extraordinary. Yet the concept was not magical. The paper worked because the government demanded taxes in it, enforced its acceptance, controlled issuance, and promised conversion or value. When political authority weakened or governments printed too much, confidence declined. The paper could become nearly worthless. In the Islamic world, beginning in the 7th century, a vast commercial civilization connected regions from the Iberian Peninsula and North Africa to the Middle East, Central Asia, India, and beyond. Islamic rulers issued gold dinars, silver dirhams, and copper coins. The words dinar and dirham had older roots, but they became deeply associated with Islamic monetary history. Early Islamic coins were influenced by Byzantine and Persian designs. Over time, rulers introduced distinctive inscriptions, often emphasizing religious statements rather than portraits. The gold dinar became highly respected for its purity and consistency. Islamic commercial law and financial practice supported sophisticated forms of partnership, investment, agency, credit, and long-distance trade. Merchants could pool capital, share risk, appoint agents, and record contracts. The sack was a written payment instrument associated with the history of the modern word check. Rather than transporting large quantities of coin, a merchant could use written instructions or claims through trusted networks. Commercial cities such as Baghdad, Cairo, Damascus, Basra, Aden, and later many others became centers of trade and finance. Merchants dealt in textiles, spices, metals, books, ceramics, medicines, food, luxury goods, and enslaved people. Market inspectors monitored weights, measures, and commercial conduct. Money changers evaluated coins from different regions, tested metal purity, and converted currencies. The money changers' table became an important symbol of finance. In Europe, after the decline of the Western Roman Empire, coinage continued, but monetary systems became more fragmented. Local rulers issued their own coins. Older Roman coins remained in circulation. Payments in kind continued to play a large role. Land, crops, livestock, labor services, and protection formed the foundation of much medieval economic life. Yet trade never disappeared. Market towns, fairs, monasteries, ports, and royal courts required systems of payment and accounting. Silver pennies became the foundation of many European currencies. Larger units, such as pounds and shillings, often began as accounting units rather than physical coins. A pound could represent a weight of silver divided into smaller units. This is why old currency systems contained relationships between pounds, shillings, and pence. The names reflected layers of Roman, Germanic, and medieval history. Medieval rulers frequently faced shortages of precious metal. Coins could be clipped around the edges, reducing their weight. Counterfeiters could mix base metals with silver or gold. Rulers could recall coins and issue new ones at altered values. Money had to be inspected, weighed, tested, and trusted. Merchants learned to recognize the currencies of different cities. Money changers became essential at fairs where traders arrived from across Europe. One of the great commercial innovations of the medieval and early modern period was the bill of exchange. Imagine a merchant from Florence buying wool in England, carrying a chest of silver across mountains, roads, and seas would be expensive and dangerous. Instead, the merchant could arrange a payment through commercial partners. A document could order one person in another city to pay a specified amount at a future date. The bill of exchange transferred value through a network of obligations. It could also include currency conversion. Merchants used differences in exchange rates and payment dates to conduct business across regions. Bills could be endorsed or transferred to other parties. Over time, they became negotiable financial instruments. This was money becoming more abstract. Value no longer had to sit physically inside the object being passed. The document represented a claim on someone else's promise to pay. Italian city-states played a major role in the development of European banking. Florence, Venice, Genoa, Siena, and other commercial centers produced powerful merchant families and financial institutions. Bankers accepted deposits, changed currencies, financed trade, transferred funds between cities, and lent money to rulers. The word bank comes from the Italian banca or banco, referring to the bench or table used by money changers. A banker who failed might have his bench broken. This is often connected with the origin of the word bankrupt, although the linguistic history is more complicated than the familiar story suggests. Banking involved great opportunity and great risk. A bank might appear wealthy because it held claims on merchants, rulers, and other borrowers. But if depositors all demanded their money at once, the bank might not possess enough coin to pay everyone. This is because banks discovered that deposited money did not need to remain untouched in a vault. Some of it could be lent. The depositor still believed the balance was available, while the borrower also possessed spending power. This process expanded credit. It also created vulnerability. Banking depended on confidence. When confidence disappeared, people rushed to withdraw funds. A bank run could destroy even an institution that might have survived under calmer conditions. The Medici family became one of the most famous banking dynasties of Renaissance Europe. Their financial network extended across major cities. The Medici used wealth to gain political influence and support art, architecture, scholarship, and religious institutions. But their story also illustrates the risks of lending to powerful rulers. Kings and princes could borrow enormous sums. If they refused or failed to repay, bankers had limited ways to force them. Financing governments could be profitable, but it could also ruin private lenders. European states needed more money as warfare grew increasingly expensive. Armies became larger. Fortifications became more complex. Ships required enormous investment. Cannons, firearms, uniforms, food, transport, and wages placed heavy pressure on royal finances. Taxes often arrived slowly and unpredictably. Rulers borrowed against future revenue. This encouraged the growth of public debt. Public debt allowed governments to raise money now and promise repayment over time. In Italian city-states, citizens could be compelled or invited to lend to the government. Claims on state revenue could later be bought and sold. Debt became an asset. One person's obligation was another person's wealth. That principle remains central to modern finance. A government bond is a debt for the issuer, but an investment for the holder. A bank deposit is an asset for the customer, but a liability for the bank. Money and debt are often two sides of the same relationship. Outside Europe, other sophisticated monetary systems were developing. In West Africa, gold supported powerful kingdoms and long-distance trade. Gold from regions south of the Sahara traveled north through caravan routes. Salt moved south. Cities such as Timbuktu, Gao, and others became important centers of commerce and learning. The Mali Empire became famous for its wealth. Mansa Musa's pilgrimage to Mecca in the 14th century became legendary. He traveled with a large entourage and distributed or spent substantial quantities of gold. Later accounts claim that the sudden increase in gold supply affected prices in regions he visited. Whether every detail of those accounts is precise or not, the story reflects Mali's extraordinary place in the medieval gold economy. Across Africa, many forms of money circulated. Gold dust could be carefully weighed using small scales and standardized weights. Copper, iron, cloth, beads, salt, cattle, and cowrie shells all served monetary functions in different regions. The diversity of money reflected the diversity of political systems, trade networks, and local resources. In the Americas, societies developed monetary practices without direct influence from Eurasian coinage. The Maya used valuable goods such as cacao beans, textiles, salt, and other commodities in exchange and tribute. Cacao beans were portable, countable, and widely desired. They could buy food and everyday goods. Because valuable objects attract imitation, counterfeit cacao beans were sometimes created by emptying shells and filling them with substitutes. Even ancient commodity money faced fraud. The Aztec Empire collected tribute from conquered regions. Tribute could include cloth, cacao, maize, feathers, precious materials, military goods, and many other products. Standardized cotton cloths could function as measures of value. Copper objects also circulated. The economy combined marketplaces, tribute, household production, political authority, and long-distance merchants. In the Andes, the Inca Empire developed an immense administrative system without relying heavily on money in the familiar market sense. Labor obligations were central. Communities provided work to the state through systems often described by the term mita. Workers built roads, cultivated state lands, served in armies, and completed public projects. In return, the state stored and redistributed food, clothing, tools, and other resources. Information was recorded using quipu, arrangements of knotted cords that encoded numerical and possibly other forms of data. This reminds us that complex civilizations do not all require coin-based economies. Money is one way of organizing obligations, but not the only way. Elsewhere, large stone discs known as rai became associated with the island of Yap in Micronesia. Some rai stones were enormous and difficult to move. Their value did not depend on being carried from one person to another. Ownership could change while the stone remained in place. The community remembered who owned it. A famous story describes a stone lost at sea whose ownership and value were still recognized because everyone accepted that it existed, even though no one could physically retrieve it. The story may have been simplified in retelling, but it illustrates a profound principle. Money does not always need to move physically. What matters is the shared record of ownership. A modern bank balance works in a similar way. The money in an account is not usually a labeled pile of notes waiting in a vault. It is an entry in a ledger. In the 15th and 16th centuries, European voyages across the Atlantic and around Africa transformed the world's monetary systems. Portuguese sailors established sea routes connecting Europe more directly with African and Asian trade. Spanish voyages reached the Americas. Conquest, colonization, forced labor, disease, and extraction redirected enormous flows of wealth. Silver became the first truly global monetary commodity. The Spanish Empire gained control over major silver deposits, especially at Potosi, in present-day Bolivia, and in regions of Mexico. Potosi grew around a mountain filled with silver ore. The mining process demanded vast quantities of labor. Indigenous communities were subjected to coercive labor systems. African enslaved labor was also used in parts of the colonial economy. Mercury was used to refine silver through amalgamation. The process was dangerous to workers and the environment. Silver coins, including the Spanish piece of 8, circulated across the Americas, Europe, Africa, and Asia. The piece of 8 became one of the most internationally recognized coins of the early modern world. It influenced later currencies, including the United States dollar. Spanish silver crossed the Atlantic to Europe, but much of it continued eastward. European merchants desired Asian silk, porcelain, spices, tea, and other goods. China's large economy had a strong demand for silver, particularly as taxes increasingly came to be assessed in silver. Spanish silver from the Americas traveled through Europe and also across the Pacific, especially through the Manila galleon trade connecting Mexico and the Philippines. Money had become global. A miner in the Andes, a merchant in Mexico City, a sailor crossing the Pacific, a trader in Manila, and a tax collector in China could all become connected through the movement of silver. The increase in silver supply also contributed to long periods of rising prices in Europe. More money was competing for goods. But inflation was influenced by many forces, including population growth, harvests, war, taxation, and market changes. The relationship between money supply and prices is powerful, but never completely simple. European colonial expansion also transformed existing African monetary systems. European and African merchants exchanged metals, textiles, firearms, alcohol, cowries, and other goods. The transatlantic slave trade turned human beings into commodities within an enormous commercial system. European merchants financed ships and cargoes. Insurers priced the risk of voyages. Plantation owners borrowed money. Banks handled payments. Governments taxed trade. Enslaved people produced sugar, tobacco, cotton, coffee, and other goods under extreme violence. These goods generated profits that flowed through ports, trading houses, banks, and state treasuries. The development of modern finance cannot be told honestly without acknowledging its connections to colonialism and slavery. Money may appear neutral when represented by numbers in an account, but the wealth behind those numbers can come from profoundly unequal systems. During the same era, new corporate forms emerged. Joint stock companies allowed many investors to provide capital for a shared enterprise. Rather than one merchant bearing the entire cost and risk of a voyage, ownership could be divided into shares. Investors could receive part of the profit. Their liability and risk could be structured through the company. The Dutch East India Company, founded in 1602, became one of history's most influential corporations. Its shares could be traded. Amsterdam developed sophisticated markets for securities. Investors bought and sold ownership claims, government debt, and other financial instruments. Markets also developed futures, options, short selling, and speculation. Many financial practices that appear modern have deep historical roots. A share was a claim on future profits. Its price depended not only on current assets, but on expectations. Expectations could rise too far. Rumors could move prices. Investors could become euphoric or fearful. The emotional rhythm of markets was already familiar. The famous Dutch tulip episode of the 1630s is often described as the first great speculative bubble. Rare tulip varieties became fashionable, and contracts for certain bulbs reached extraordinary prices. the popular story is sometimes exaggerated. Not all Dutch society abandoned ordinary life to trade flowers, and the economic damage was more limited than later legends suggested. Still, the episode became a lasting symbol of speculation. An object's market price can rise because people believe someone else will pay even more. When that belief disappears, the price can fall rapidly. England experienced another major transformation in money and banking. Goldsmiths originally worked with precious metals and maintained secure vaults. People began depositing coins and valuables with them for safekeeping. The goldsmith issued a receipt. Over time, some receipts could be transferred to others. The receipts began functioning like money. Goldsmiths also made loans. Borrowers could receive receipts rather than metal. As long as the public trusted the goldsmith, these paper claims circulated. Once again, money expanded through credit. The amount of paper claims could exceed the metal held in reserve. This was an early form of fractional reserve banking. In 1694, the Bank of England was founded. The English government needed funds for war. Private investors provided capital, and the bank lent money to the government. In return, the bank received privileges, including the ability to issue banknotes. The Bank of England was not the first central bank in every sense. Sweden's Riksbank had been established earlier, but the Bank of England became exceptionally influential. It connected government debt, banking, currency issuance, and national finance. The government could borrow more effectively because investors believed taxes would support repayment. Public debt became permanent and organized. Instead of attempting to repay every wartime loan immediately, the state could issue long-term debt and service the interest. This helped Britain finance repeated wars and build global power. Banknotes initially represented claims on coin. A note might promise to pay the bearer a specified amount. Large notes were often used by merchants and wealthy individuals. Over time, smaller denominations expanded public use. But early banknotes were not always issued by one central authority. Many private banks issued their own notes. A person receiving a note had to consider the reputation of the bank. Would the bank redeem it? Was the note counterfeit? How far away was the issuing institution? Notes from a distant or weak bank might trade below their printed value. Trust created exchange rates even within one country. Counterfeiting became a serious concern. Governments and banks introduced detailed engraving, special paper, complex designs, signatures, serial numbers, watermarks, and severe legal penalties. A banknote became an artwork designed around mistrust. Every line and pattern helped distinguish the genuine promise from the false one. In North American colonies, shortages of coin encouraged monetary experimentation. Colonists used foreign coins, commodity money, warehouse receipts, and local paper currency. Tobacco notes represented claims on stored tobacco. Wampum, made from shell beads, had ceremonial, social, and monetary significance among indigenous peoples, and was also adopted in some colonial exchanges. Colonial governments issued bills of credit. These paper notes helped finance military and administrative expenses. Their value varied depending on the credibility of the issuing colony and the quantity printed. The American Revolution was financed partly through paper currency known as continental currency. As more notes were issued and confidence weakened, their value collapsed. The expression "not worth a continental" reflected this depreciation. After independence, the United States faced the challenge of creating a stable monetary system. The Constitution gave the federal government important powers over currency. The Coinage Act of 1792 established a mint and defined the dollar in relation to gold and silver. The word dollar came through European usage associated with the thaler, a large silver coin. Spanish dollars continued to circulate widely in the young United States. The dollar sign may have developed from scribal abbreviations related to pesos, although several origin stories exist. The early United States used a bimetallic standard. Both gold and silver had legally defined relationships to the dollar, but maintaining a fixed ratio between two metals was difficult. The market value of gold relative to silver changed. When the legal ratio differed from the market ratio, one metal tended to disappear from circulation. People spent the legally overvalued metal and saved, melted, or exported the undervalued one. This pattern is often summarized by the phrase, "bad money drives out good," known as Gresham's Law. The full reality depends on legal rules and exchange conditions, but the principle is useful. When two forms of money are required to circulate at the same official value, people tend to keep the one they consider more valuable. The United States also experienced repeated debates over national banking. Alexander Hamilton supported the creation of a national bank to strengthen public credit, manage government funds, and support commerce. Opponents feared concentrated financial power and questioned the constitutionality of the institution. The first Bank of the United States was created, later allowed to expire, followed by the second bank. President Andrew Jackson strongly opposed the second bank and helped bring about its end. The resulting period included many state-chartered banks issuing notes. The quality of these notes varied widely. Some banks were sound, others were poorly managed, fraudulent, or located in remote areas where redemption was difficult. Banknote reporters and counterfeit detectors helped merchants evaluate unfamiliar currency. The 19th century was an age of industrialization, urbanization, railroads, factories, and expanding finance. Large projects required large pools of capital. Railway companies sold bonds and shares. Banks financed machinery, inventories, land, and construction. Insurance companies spread risk. Stock exchanges became more organized. Telegraphs allowed financial information to move faster than people or physical money. A price change in one city could influence another market almost immediately. Money accelerated. Industrial workers increasingly depended on wages. Instead of producing most necessities within a household or village, workers earned money and used it to buy food, housing, clothing, fuel, and other essentials. Time itself became monetized. Factories measured hours and output. Clocks disciplined the working day. A worker sold labor for a wage. The employer expected the value produced during that time to exceed the wage and other costs. Money shaped daily life more directly than ever. But industrial finance was unstable. Banks created credit during optimistic periods. Loans supported investment, land purchases, speculation, and construction. When confidence changed, credit contracted. Businesses failed. Banks suspended payments. Workers lost jobs. Financial panics occurred repeatedly. The 19th century experienced dramatic crises in the United States, Britain, Europe, Latin America, and elsewhere. The pattern was often familiar. Rising confidence encouraged borrowing. Borrowing increased demand and asset prices. Higher prices encouraged more borrowing. Eventually, some shock exposed weakness. Lenders became cautious. Borrowers sold assets to raise cash. Prices fell. Falling prices damaged collateral and created further panic. The cycle of credit expansion and contraction became one of the defining rhythms of modern capitalism. Gold gained increasing importance as the basis of international currency. Britain formally adopted a gold standard in the 19th century. Under a classical gold standard, the currency was defined as a specific quantity of gold. Banknotes could, under normal conditions, be exchanged for gold. Other countries gradually joined gold-based systems. Exchange rates became relatively stable because each currency represented a fixed weight of gold. If £1 and $1 were each defined by specific gold amounts, their exchange rate could be calculated from those definitions. The gold standard supported international trade and investment by reducing currency uncertainty, but it also imposed strict limits. A country losing gold might have to raise interest rates, reduce credit, cut spending, and lower prices to restore balance. These adjustments could cause unemployment and economic pain. The system gave priority to maintaining convertibility, sometimes at the expense of domestic stability. Gold did not automatically create perfect discipline. Banks still created credit. Financial crises still occurred. Governments sometimes suspended convertibility during wars. The amount of monetary activity could grow far beyond the gold physically changing hands. Gold acted as the anchor, but the financial structure above it depended on promises. Major gold discoveries changed the world economy. The California gold rush began in 1848. Gold discoveries in Australia followed. Later, major production developed in South Africa and elsewhere. New gold supplies expanded monetary reserves and influenced global prices. Mining camps became towns. Transport routes expanded. Merchants sold supplies. Fortunes were made and lost. Indigenous communities were displaced, environments damaged, and laborers exposed to dangerous conditions. Once again, the story of money included both opportunity and exploitation. Silver remained politically important. In the United States, farmers and debtors often favored expanding the money supply through silver. A larger money supply could raise prices and make debts easier to repay in nominal terms. Creditors and many financial interests preferred tighter money and stronger gold commitments. The conflict produced the free silver movement. William Jennings Bryan's famous political speeches attacked the idea that ordinary people should be sacrificed to a rigid gold system. The debate was not merely technical. It concerned who benefited from monetary policy. A rise or fall in the value of money affects debtors and creditors differently. Deflation increases the real burden of debt because each unit of money becomes harder to obtain and more valuable. Inflation reduces the real value of fixed debts, although it also harms people whose incomes and savings fail to keep pace. No monetary system is neutral. It distributes gains, losses, risks, and power. During the American Civil War, the United States issued paper money known as greenbacks. These notes were not immediately convertible into gold. They helped the Union finance the war. Their value fluctuated according to military events, public confidence, and expectations about future redemption. The federal government also created a new national banking framework. National banks could issue standardized notes backed by government bonds. This reduced some of the confusion created by thousands of different state banknotes. Taxes were placed on state banknote issuance, encouraging a more unified currency. Yet the American banking system remained prone to crises. Seasonal demands for currency, especially around harvest time, could strain reserves. Banks were connected through networks of deposits. Trouble in one region could spread. The Panic of 1907 became especially important. A failed attempt to control the stock of a company triggered wider fear. Trust companies faced withdrawals. Credit markets froze. The financier J.P. Morgan helped coordinate private rescue efforts, gathering bankers and directing support toward institutions considered salvageable. The crisis demonstrated the danger of relying on one private individual to stabilize the national financial system. It strengthened support for a central bank. In 1913, the Federal Reserve System was created. The Federal Reserve was designed as a network of regional reserve banks overseen by a central board. It could provide an elastic currency, hold bank reserves, facilitate payments, and serve as a lender of last resort. A lender of last resort provides emergency liquidity to financial institutions during a panic. The goal is to prevent temporary fear from destroying otherwise viable banks. But central banking always involves difficult judgment. Support offered too freely can encourage reckless behavior. Support offered too slowly can allow panic to spread. The central bank stands between discipline and rescue. The First World War shattered much of the classical gold standard. Governments needed extraordinary amounts of money for soldiers, weapons, transport, food, and supplies. They raised taxes, borrowed heavily, and issued currency. Gold convertibility was suspended in many countries. War bonds encouraged citizens to lend savings to the state. Propaganda turned financial participation into patriotic duty. After the war, governments attempted to restore monetary stability. But the world had changed. Debts were enormous. Economic power had shifted. Exchange rates no longer reflected pre-war realities. Some countries experienced severe inflation. The most famous case occurred in Germany during the early 1920s. Germany faced war debts, reparations, political instability, and conflict over government revenue. When production and tax collection weakened, the government increasingly financed spending by creating money. Prices rose. As people lost confidence, they tried to spend money quickly before its value fell further. The speed at which money circulated increased. Wages had to be paid more frequently. Prices could change within hours. Banknotes appeared in enormous denominations. People carried bundles of currency to buy ordinary goods. The familiar images of wheelbarrows filled with notes symbolized hyperinflation. But the paper itself was not the true cause. The collapse reflected a breakdown in the fiscal, political, and productive foundations of the currency. Hyperinflation destroys more than savings. It damages social trust. Long-term contracts become impossible. Wages lose meaning. Creditors are wiped out. Debtors may benefit temporarily, but economic coordination collapses. People turn toward foreign currencies, commodities, barter, or anything expected to hold value. Germany eventually stabilized its currency through monetary and fiscal reforms and the introduction of a new unit. But the psychological scars remained. The 1920s also saw rapid growth in consumer credit. Households bought automobiles, radios, appliances, and furniture through installment plans. Instead of saving the full purchase price, customers paid over time. Credit expanded consumption and supported industrial production. Advertising encouraged people to imagine better lives available through immediate purchase. Debt became part of ordinary household life. Stock market participation also expanded. Investors bought shares with borrowed money using margin. Rising prices encouraged further borrowing. In October 1929, the American stock market crashed. The crash did not single-handedly cause the Great Depression, but it exposed financial weakness and damaged confidence. Banks failed in waves. Depositors rushed to withdraw currency. Because banks kept only part of deposits in cash, mass withdrawals forced them to sell assets or close. The money supply contracted, prices fell, debts became harder to repay. Businesses cut production and employment. Unemployment rose to devastating levels. The Great Depression transformed thinking about money, banking, and government. In the United States, President Franklin D. Roosevelt declared a banking holiday in 1933. Banks were temporarily closed and examined. The government sought to restore confidence. Deposit insurance was introduced, reducing the incentive for ordinary depositors to run at the first rumor of trouble. The United States also changed its relationship with gold. Private ownership and redemption rules were restricted. The official gold price was later changed, effectively devaluing the dollar against gold. Other countries also abandoned gold commitments. Leaving gold gave governments and central banks more flexibility, though recovery remained slow and uneven. The economist John Maynard Keynes argued that governments could not always wait for markets to correct themselves. During severe downturns, private spending and investment might remain too weak. Government spending could support demand and employment. Monetary policy could lower interest rates, but if fear was extreme, people and businesses might still refuse to borrow and spend. The Great Depression made money a central tool of economic management. The Second World War required another massive financial mobilization. Governments taxed, borrowed, rationed, controlled prices, and directed industrial production. Citizens purchased war bonds. Banks and central banks supported government borrowing. After the war, leaders attempted to design a more stable international monetary order. In 1944, representatives of Allied nations met at Bretton Woods in New Hampshire. They created a system in which many currencies were linked to the United States dollar, while the dollar was convertible into gold for foreign monetary authorities at a fixed rate. The dollar became the center of the system. Institutions including the International Monetary Fund and the World Bank emerged from the Bretton Woods framework. The IMF was intended to support countries facing balance of payments problems and promote exchange rate stability. The World Bank initially focused on reconstruction and development. The post-war monetary order reflected the economic strength of the United States, which held a large share of the world's gold reserves and industrial capacity. Under Bretton Woods, exchange rates were fixed but adjustable. Countries could maintain some control over domestic policy while limiting disruptive currency movements. Capital controls were common. Money could not always flow freely across borders. The decades after the war brought strong growth in many industrialized countries, expansion of the middle class, rising wages, suburban development, and growing consumer finance. But access to credit and wealth was deeply unequal. In the United States, discriminatory housing and lending practices prevented many black families and other marginalized groups from receiving the same mortgage opportunities and accumulating comparable property wealth. Money does not merely record value. Financial institutions influence who is able to build value in the first place. The physical experience of money was also changing. Checking accounts became increasingly common. A paper check instructed a bank to transfer money from one account to another. The customer did not hand over currency. The payment occurred through adjustments in bank ledgers. Banks processed mountains of paper. Machines using magnetic ink helped sort checks. The financial system became an enormous information processing network. Credit cards represented another major shift. Earlier charge cards and store accounts had allowed trusted customers to buy on credit. In the mid-20th century, general-purpose cards expanded. A card allowed a customer to purchase from many merchants. The issuing institution paid the merchant and later collected from the customer. For merchants, cards increased convenience and sales. For customers, cards separated the moment of purchase from the moment of payment. Psychologically, this mattered. Handing over physical cash creates a visible sense of loss. A card makes spending feel more abstract. The customer receives goods now and confronts the full cost later. If the balance is not repaid, interest accumulates. Credit cards are both payment tools and lending products. Their profitability depends partly on fees, merchant charges, interest, and customer behavior. The card itself is not money in the strictest sense. It is a device that gives access to a credit line or account. The actual settlement occurs through a network of banks, processors, card companies, and merchant accounts. By the 1960s, the Bretton Woods system faced growing pressure. The world needed dollars for trade and reserves. The United States supplied dollars through overseas spending, investment, military commitments, and deficits. But the more dollars held outside the United States, the harder it became to guarantee that every official dollar claim could be converted into gold at the promised rate. This created a fundamental tension. The dollar had to be widely available to support the global system, yet excessive dollar creation weakened confidence in gold convertibility. In August 1971, President Richard Nixon announced the suspension of the dollar's conversion into gold for foreign governments. This decision is often called the Nixon shock. The fixed exchange rate system gradually ended. Major currencies began to float more freely against one another. The dollar was no longer defined by a fixed amount of gold. It became fiat money. Fiat money has value because it is issued and supported by government, accepted for taxes, recognized by law, and trusted by users. The word fiat comes from a Latin expression meaning roughly, "let it be done." Critics sometimes describe fiat money as backed by nothing, but this is misleading. Fiat currency is not redeemable for a fixed quantity of gold, but it is supported by institutions, taxation, legal systems, productive capacity, monetary policy, and collective acceptance. Its backing is social and political rather than metallic. This can be extremely powerful. It can also be abused. A government with control over its currency can respond to crises, support banking systems, and adjust monetary conditions. But excessive money creation relative to the economy's productive capacity can contribute to inflation and loss of confidence. The 1970s brought high inflation to many countries. Oil shocks raised energy costs. Wage and price dynamics became difficult to control. Governments struggled with stagflation, a combination of inflation and weak economic growth. Traditional models had not always expected high unemployment and high inflation to occur together. Central banks eventually adopted tighter policies. In the United States, Federal Reserve Chairman Paul Volcker raised interest rates dramatically beginning in the late 1970s and early 1980s. Borrowing became expensive. Recession followed. Unemployment rose. But inflation eventually declined. The episode demonstrated the power and pain of monetary policy. A central bank can influence the economy by changing short-term interest rates, managing reserves, communicating future policy, and buying or selling financial assets. When rates fall, borrowing tends to become cheaper. This can encourage spending, investment, and higher asset prices. When rates rise, borrowing becomes more expensive. Demand may slow, reducing inflationary pressure, but monetary policy works through millions of decisions and with uncertain delays. It is more like steering an enormous ship through fog than pressing a precise button. By the late 20th century, money was becoming increasingly electronic. Employers deposited wages directly into bank accounts. Customers withdrew cash from automated teller machines. Debit cards allowed purchases to be deducted from deposits. International payment networks moved funds across borders. Banks communicated through secure electronic messages. Stock exchanges shifted from crowded trading floors toward computerized systems. Most money no longer existed as notes and coins. It existed as entries in databases. Commercial banks created much of this money through lending. When a bank approves a loan, it does not always transfer a pile of existing cash from one customer to another. It can create a deposit in the borrower's account. The borrower now has money to spend, and the bank has a loan asset representing the borrower's obligation to repay. As the loan is repaid, part of the created deposit money is effectively extinguished. This does not mean banks can create unlimited money without constraint. They face capital requirements, liquidity needs, regulation, credit risk, funding costs, central bank policy, and the demand for sound borrowers. Still, the process shows that modern money is deeply connected with debt. Central bank money and commercial bank money are different layers. Physical currency and bank reserves are liabilities of the central bank. Ordinary bank deposits are liabilities of commercial banks. People generally treat them as equivalent because deposits can usually be converted into currency and transferred through the payment system. Deposit insurance and regulation reinforce confidence. Money works because the layers remain connected. Globalization accelerated monetary flows. Corporations built supply chains across many countries. Foreign exchange markets traded trillions of dollars worth of currencies. Investors move money between bonds, shares, commodities, real estate, and emerging markets. Exchange rates responded to interest rates, trade, political events, expectations, and risk. A currency could strengthen because investors sought safety or higher returns. It could weaken because of inflation, instability, falling exports, or declining confidence. For countries borrowing in foreign currency, exchange rate changes could be devastating. A company might earn revenue in local money but owe debts in dollars. If the local currency fell, the debt burden would grow. Financial crises in Latin America, Asia, Russia, and elsewhere demonstrated the dangers of rapid capital inflows followed by sudden exits. Money could enter a country quickly during optimism and flee even faster during fear. The financial industry developed increasingly complex instruments. Derivatives derived their value from something else, such as an interest rate, currency, commodity, bond, or stock index. Futures allowed participants to lock in prices for later delivery. Options provided rights, but not obligations, to buy or sell under specified terms. Swaps exchanged streams of payments. These instruments could reduce risk. A farmer could hedge against falling crop prices. An airline could hedge fuel costs. A company could manage currency exposure. But derivatives could also increase leverage and hide risk. The same tool that offers protection can support speculation. Money once again became a network of promises layered upon promises. The internet changed finance further. Online banking allowed customers to view accounts and transfer money without entering a branch. Electronic commerce allowed businesses to sell globally. Payment companies created new ways for strangers to transact. Digital marketplaces needed systems to prevent fraud, verify identities, reverse unauthorized payments, and resolve disputes. Convenience depended on invisible infrastructure. A simple online purchase might involve the customer's bank, the merchant's bank, a card network, a payment processor, a fraud detection system, data centers, telecommunications networks, and settlement systems. The customer sees one click. Behind that click is an entire architecture of trust. In 2007 and 2008, a global financial crisis revealed the fragility of this architecture. For years, housing prices in the United States had risen. Mortgage lending expanded. Some borrowers received loans they could not safely afford. Mortgages were bundled into securities and sold to investors. Financial models attempted to estimate the risk. Credit rating agencies assigned ratings. Banks and investment firms borrowed heavily to hold mortgage-related assets. Derivatives spread exposure across institutions. The system appeared diversified. In reality, many participants depended on the same assumption, that widespread housing losses would remain limited. When home prices fell and mortgage defaults increased, confidence collapsed. Securities became difficult to value. Institutions stopped trusting one another. Short-term lending markets froze. Lehman Brothers failed in September 2008. Other major institutions required rescue, restructuring, or emergency support. Governments guaranteed debts, injected capital, protected deposits, and introduced stimulus measures. Central banks lowered interest rates and created enormous emergency lending programs. They also used quantitative easing. Through quantitative easing, a central bank purchases government bonds and sometimes other assets, creating reserves in the banking system. The goal is to lower longer-term interest rates, support asset prices, improve financial conditions, and encourage lending and spending. Critics argued that rescues protected powerful financial institutions, while ordinary households suffered unemployment, foreclosure, and lost wealth. Supporters argued that allowing the financial system to collapse would have produced even greater damage. Both perspectives reveal the difficult politics of money. When the system is stable, private institutions may earn profits. When the system is threatened, public authorities may be forced to absorb risk. The crisis damaged trust in banks, governments, and experts. In this atmosphere, a mysterious person or group using the name Satoshi Nakamoto introduced Bitcoin. In October 2008, a paper described a peer-to-peer electronic cash system. Bitcoin began operating in 2009. Its goal was to allow digital value to be transferred without relying on a central bank or traditional payment intermediary. The system used a blockchain. A blockchain is a shared ledger maintained across a network. Transactions are grouped into blocks. Cryptographic methods connect each block to the previous one. Participants known as miners compete to validate transactions and add new blocks through proof of work. The process requires computing power and energy. Bitcoin introduced a predetermined issuance schedule. The total supply was designed to approach a maximum of 21 million coins. Supporters viewed this scarcity as protection against discretionary money creation. They compared Bitcoin to digital gold. Critics noted its price volatility, energy use, limited transaction capacity, regulatory uncertainty, and use in speculation or illegal activity. Bitcoin's value did not come from physical usefulness or government tax authority. It came from scarcity, network participation, security, belief, and the expectation that others would accept it. In that sense, it forced an old question into a new form. Why does anything function as money? Gold works partly because people have trusted and desired it for thousands of years. Fiat currency works because states support it, and societies organize prices, taxes, debts, and wages around it. Bank deposits work because people trust banks, regulation, deposit insurance, and central bank settlement. Bitcoin works to the extent that users trust the protocol, the network, its scarcity, and the possibility of future acceptance. Every form of money rests on some kind of shared belief, but belief alone is not enough. The belief must be supported by systems, incentives, institutions, scarcity, usefulness, or power. After Bitcoin, thousands of other cryptocurrencies appeared. Some attempted to improve payment speed or privacy. Some supported programmable applications and smart contracts. Ethereum expanded the idea of blockchain beyond simple currency transfer. Developers could create applications whose rules were executed by the network. Tokens represented voting rights, access, assets, collectibles, or speculative projects. Stablecoins attempted to maintain a steady value, often linked to the United States dollar. A stablecoin issuer might hold reserves such as cash and government securities. Users could move dollar-like tokens across blockchain networks. But stablecoins reintroduced familiar questions. Are the reserves real? Are they safe? Can holders redeem the tokens? Who regulates the issuer? A supposedly new form of money could begin to resemble an old private banknote. Cryptocurrency markets experienced dramatic booms and crashes. Prices rose as new investors entered. Leverage expanded. Celebrities promoted tokens. Digital artwork and collectibles sold for large sums through non-fungible tokens, or NFTs. Some projects built useful technology. Others were poorly designed, manipulated, or fraudulent. Exchanges failed. Lenders collapsed. Investors discovered that decentralization at the level of a blockchain did not guarantee safety when assets were entrusted to centralized companies. The ancient lesson returned once more. The ledger may be new, but trust, custody, debt, greed, and panic are very old. Mobile phones transform money across many parts of the world. In regions where traditional banking infrastructure was limited, mobile money systems allowed users to send value through phone networks. A person could deposit cash with an agent, receive an electronic balance, transfer funds by phone, and allow the recipient to withdraw through another agent. Kenya's M-Pesa became one of the most famous examples. Mobile money made it easier to send support to relatives, pay merchants, receive wages, and conduct business without a conventional bank account. The success of mobile money demonstrates that financial innovation does not always begin in the wealthiest countries. Sometimes systems develop fastest, where older infrastructure leaves the greatest need. China experienced rapid growth in mobile payment platforms. Quick response codes allowed customers to pay with smartphones. Street vendors, restaurants, taxis, and major retailers accepted digital payments. For many people, physical cash became less important. Payment platforms grew into financial ecosystems, offering savings, credit, investment, insurance, and other services. This created convenience, but it also concentrated data and power. A payment company could learn where people shopped, traveled, ate, and spent. Money became information. The history of money had always involved records. Now those records became detailed, automatic, and searchable. Governments and central banks began exploring central bank digital currencies. A central bank digital currency, often called a CBDC, would be a digital liability of the central bank available in some form to the public. It could offer fast payments, reduce dependence on cash, and support financial inclusion. But design choices matter. Would users hold accounts directly with the central bank? Would private banks and payment providers remain intermediaries? Would transactions be private? Could money be programmed with restrictions? Could authorities freeze funds instantly? Supporters emphasize efficiency and resilience. Critics worry about surveillance, cybersecurity, government control, and disruption to commercial banking. The future of money may depend less on whether it is digital, because much of it already is, and more on who controls the ledger. Cash offers a special kind of freedom. A banknote can be handed directly from one person to another. It does not require electricity, an internet connection, permission from a payment company, or the recording of personal data. But cash can be lost, stolen, counterfeited, or used anonymously in crime. Digital payments are convenient and traceable, but they depend on networks and institutions. Every payment system balances privacy, security, speed, access, and control. No design maximizes all of them at once. During the COVID-19 pandemic, governments around the world responded to sudden economic shutdowns. Businesses closed or reduced activity. Workers lost income. Supply chains were disrupted. Governments increased spending, supported households and companies, and expanded borrowing. Central banks lowered interest rates and purchased assets. The scale of intervention was extraordinary. These measures helped prevent deeper collapse, but as economies reopened, demand recovered faster than some supply systems. Shortages, shipping problems, energy shocks, labor market changes, housing pressures, and later geopolitical conflict contributed to rising prices. Inflation returned as a central concern. People often speak about inflation as if every price rises at the same speed. In reality, inflation is uneven. Housing may rise faster than clothing. Food and energy can fluctuate sharply. Wages may lag behind. Asset prices may rise for years before consumer price inflation becomes obvious. Each household experiences a different personal inflation rate based on what it buys. Inflation also changes the emotional meaning of money. A number in a savings account may remain the same while its purchasing power quietly falls. A wage increase can feel disappointing if rent and food rise faster. People begin to compare prices across time. They remember when a meal, house, or car cost less. But comparing prices across decades requires considering wages, quality, taxes, interest rates, and changing lifestyles. Money is the ruler by which we measure economic life, yet the length of the ruler itself changes. Central banks often aim for low, stable, positive inflation rather than perfectly fixed prices. A small amount of inflation can allow wages and relative prices to adjust more easily and reduce the risk of deflation. Deflation may sound pleasant because goods become cheaper, but broad, persistent deflation can cause people to delay spending, reduce business revenue, increase the real burden of debt, and contribute to unemployment. The goal is stability, not simply the lowest possible prices. Today, the majority of money exists only as numbers. A salary arrives as a digital entry. A mortgage is a digital obligation. A stock portfolio is a collection of electronic ownership records. A government bond is a promise stored in financial systems. A contactless payment takes seconds. Currency traders move enormous sums without seeing a single banknote, yet physical money remains powerful as a symbol. People give cash in greeting cards. Coins are placed in fountains. Banknotes display national heroes, monuments, animals, rulers, writers, scientists, and landscapes. Currency tells a society what it wishes to remember. Changing a banknote design can become a political debate because money passes through every hand. It is one of the most widely distributed forms of public art. Money also affects the mind. People do not treat every dollar in exactly the same way. Behavioral economists describe mental accounting. A person may spend a tax refund differently from ordinary wages, even though the money has identical purchasing power. Someone may keep expensive credit card debt while maintaining a low-interest savings account because the savings have been mentally assigned to a special purpose. People may take greater risks with unexpected gains. Losses often feel more painful than equivalent gains feel pleasurable. Prices ending in 99 can feel meaningfully lower than the next whole number. Subscription payments can fade into the background because the spending decision is not repeated each month. Money is mathematical, but our relationship with it is emotional. It can represent safety, freedom, status, love, fear, shame, opportunity, or control. For one person, saving money means protection from childhood uncertainty. For another, spending money means enjoying life while there is time. For another, wealth means public success. For another, it means privacy and independence. The same number can feel enormous or insufficient depending on expectations. Modern money is also tied to inequality. Wealth is not the same as income. Income is a flow received over time. Wealth is the stock of assets accumulated, including property, businesses, investments, savings, and valuable possessions minus debts. Two people with similar salaries can have very different wealth. One may inherit a home or investment portfolio. Another may support relatives, pay high rent, or carry student debt. Assets can generate further assets. Property can appreciate. Shares can produce dividends. Businesses can grow. Those without assets depend mainly on labor income. Money, therefore, has momentum. Past wealth creates future opportunity. This is why debates over taxation, inheritance, wages, housing, education, and credit are also debates about money's long historical path. The creation of money remains politically contested. Some people fear that governments and central banks create too much. Others argue that public institutions should use monetary capacity more aggressively to achieve full employment, build infrastructure, or respond to climate change. Some favor strict rules tied to gold, money supply growth, or inflation targets. Others prefer flexibility. Some support private currencies or cryptocurrencies. Others view stable public money as a basic social institution. There is no final agreement because money sits at the intersection of economics and politics. It determines who can claim resources. Creating money can redirect labor, materials, land, and technology. But money cannot create unlimited real resources. A government can issue currency, but it cannot instantly produce more trained doctors, fertile land, energy, homes, or machinery. If spending power rises far beyond available goods and services, prices may increase. The true limit of money is often not the number of notes or digital entries. It is the productive capacity of society and the confidence of the people using the currency. And now, after this long journey, we can look back. Money began not as a single invention, but as many overlapping practices: sharing, remembered favors, debt, grain accounts, livestock, shells, metal by weight, stamped coins, paper claims, bank deposits, government notes, gold convertibility, credit cards, electronic balances, cryptographic tokens. Each form solved certain problems and created new ones. Commodity money could preserve value, but it was difficult to transport. Coins were durable, but rulers could debase them. Paper was light, but it required trust. Banks expanded credit, but they could fail. Gold limited governments, but it also limited their response to crises. Fiat money offered flexibility, but it depended on responsible institutions. Digital payments increased speed, but reduced privacy. Cryptocurrency reduced reliance on central issuers, but introduced volatility and technological risk. There has never been a perfect money. Every monetary system is a compromise. Money must be scarce enough to retain value, but available enough to support exchange. It must be stable, but flexible. Private enough to preserve freedom, but transparent enough to prevent fraud. Easy to use, but difficult to counterfeit. Widely accepted, but not endlessly created. Money is sometimes described as the root of all evil, although the older saying more precisely warns about the love of money. Money itself does not possess intention. It is a tool, a language, a claim, and a social agreement. It can finance hospitals or armies. It can reward invention or exploitation. It can free a person from dependence or place an entire family under crushing debt. It reflects the priorities of those who control and use it. Perhaps the deepest truth is that money is a form of collective imagination. A coin is metal, but society sees purchasing power. A banknote is printed material, but society sees value. A bank balance is data, but society sees possibility. The imagination is not false. It is made real through shared rules and behavior. A border is also an idea, yet it can shape lives. A law is written language, yet it can command institutions. Money belongs to this same category of powerful human creations. Its reality is social. And because it is social, it can change. The future may bring currencies that move instantly across borders. Artificial intelligence may manage spending, investing, credit, and fraud detection. Machines may pay other machines for electricity, data, transport, or computing power. Digital identity systems may become closely tied to financial access. Tokenized assets may allow ownership of property, securities, art, or commodities to be divided and transferred through new ledgers. Central bank digital currencies may exist alongside bank deposits, stable coins, cryptocurrencies, and physical cash. Some countries may attempt to reduce dependence on the dollar. New payment alliances may emerge. But the oldest questions will remain. Who issues the money? Who controls the ledger? Who receives credit? Who carries the risk? What makes the system trustworthy? What happens when promises cannot be kept? And what should money allow human beings to do? Perhaps money will become nearly invisible. A person may enter a store, take an item, and leave while sensors handle payment automatically. A vehicle may pay a road toll without human attention. A house may buy electricity when prices fall. Software may divide income among taxes, bills, investments, insurance, and savings the moment it arrives. The friction of payment may almost disappear. But there is a quiet danger in perfect convenience. Friction creates moments of awareness. Counting bank notes reminds us that something is being surrendered. Waiting before a purchase gives desire time to fade. When spending becomes invisible, control may become harder. The future of money will therefore require not only better technology, but greater wisdom. After thousands of years, money has become one of civilization's most powerful tools. It connects strangers who may never meet. A farmer can produce food for people hundreds of miles away. A worker can contribute one specialized task and receive money accepted for countless other goods. A saver can lend resources to a business. A government can gather contributions from millions of people and build shared infrastructure. Money allows cooperation at a scale beyond family, village, or tribe. But money can never fully measure what matters. It can assign a price to labor, land, art, time, and risk. It cannot perfectly measure love, dignity, beauty, loyalty, peace, or a meaningful life. Some valuable things have no market price. Some expensive things have little lasting value. The history of money is therefore not merely the history of wealth. It is the history of how human beings learn to place numbers on promises. It is the history of trust extended across distance and time. It is the history of rulers and citizens, lenders and borrowers, workers and merchants, miners and sailors, farmers and bankers, inventors and speculators. It is the story of clay tablets pressed by ancient scribes, of silver weighed in crowded markets, of coins carrying the faces of emperors, of cowrie shells strung together beneath the sun, of caravans crossing deserts with gold and salt, of paper notes carried along Chinese roads, of merchants signing bills in candlelit rooms, of ships carrying silver across oceans, of goldsmiths guarding deposits behind heavy doors, of printing presses producing government promises, of telegraphs carrying prices through wires, of checks moving through sorting machines, of cards passing across counters, of computers updating invisible ledgers, and of cryptographic networks operating without sleep. All of these systems were created because human beings needed ways to cooperate, remember, exchange, measure, and plan. Money allowed value to travel across a market, across an empire, across an ocean, across generations. And now, as our journey comes gently toward its end, Imagine holding a simple coin in your hand. Feel its cool surface. Notice its weight. On one side, perhaps there is a face. On the other, a symbol. The coin looks small, but hidden inside it is an enormous history. There are ancient mines and royal mints. There are market stalls and tax collectors. There are armies paid before long campaigns. There are merchants checking scales. There are rulers promising purity. There are people saving for winter. There are parents buying food. There are workers receiving wages. There are travelers exchanging one currency for another. The coin is not only metal, it is a small, quiet agreement. Now imagine a banknote. The paper is light enough to move with the air, yet it may represent hours, days, or weeks of labor. It may buy a meal, a book, a gift, or a night of shelter. Its material value is tiny. Its social value is much greater. And finally, imagine the balance in a digital account. There is nothing to hold, no weight, no sound, no physical object, only records stored within machines. And still, those records can open doors, cross borders, build homes, fund businesses, or disappear during a crisis. We have traveled from memory to clay, from clay to metal, from metal to paper, from paper to electricity, and from electricity to cryptography. Yet beneath every transformation lies the same fragile foundation: trust. Trust that the grain will be delivered. Trust that the silver is pure. Trust that the coin has the correct weight. Trust that the bank will redeem the note. Trust that the government will protect the currency. Trust that the account balance is accurate. Trust that the code will operate as promised. When trust is strong, money seems solid. When trust weakens, even gold can be hidden. Banknotes rejected, banks emptied, and digital markets abandoned. The true history of money is the history of organized trust. And trust, like sleep, cannot always be forced. It grows gradually through consistency, memory, and repeated experience. So let the long story begin to settle now. Let the markets grow quiet. Let the caravans rest beside the road. Let the scribes place their clay tablets on the shelf. Let the bankers close their ledgers. Let the minting hammers become still. Let the last coins fall gently into their wooden boxes. Across the old cities, the lamps are being extinguished. The stalls are empty. The ships are anchored. The vault doors are closed. The computers continue their silent counting, but you no longer need to follow them. The numbers may move without you. The currencies may rise and fall. The banks may open again in the morning. But for now, there is nothing to buy, nothing to sell, nothing to calculate, and nothing to owe. For now, you can simply rest. You have followed the story of money from the first remembered promise to the invisible networks of the modern world. You have watched it change its shape again and again. And now the story can fade into the background, becoming softer and more distant, like the quiet sound of an old coin turning slowly on a wooden table, circling once, then again, moving more gently each time, until at last it becomes still. And the long history of money rests quietly beside you as you drift into peaceful sleep.